Okay, welcome to this video on managing working capital and liquidity. If this is your first encounter with the Let Me Explain YouTube channel, then I hope you enjoyed the video. Consider subscribing and even supporting the channel as a member. So join the channel to get access to all the video resources that we have on the channel, which of course are CFA exam related. Right, on with the topic at hand. Managing working capital, I guess, pretty much as the same goes for everything, should be oriented towards maximizing the value of the company, the value of the firm. So on the one hand, we're trying to maximize firm value, which should keep, as one of the facets of that, should keep costs low, including the cost of funding. But at the same time, you need to maintain ready access to funds, so that's liquidity. There's a trade-off here, and that's what working capital is going to be all about. So ideally, what you should do is you should determine, what working capital management is all about. It's on the one hand establishing your optimal level of working capital, optimal working capital levels or working capital needs, requirements. And in a moment we'll talk about different approaches to this, because your book outlines 3 different approaches: conservative, aggressive, and sort of moderate. This, how much working capital we need should typically be stated in relation to the size of the business. So in relation to how much business we're doing, probably in relation to revenue, and then, obviously create revenue forecasts, because if revenue is the primary driver of working capital needs, forecast your revenue. And as a result, you'll be able to forecast your working capital requirements. Okay, that's essentially the thing. And when you work on, valuation models, this is what you do. You forecast the necessary investment in things like capital expenditure, so capex, but also increasing working capital investments. Now, with regard to how one should choose the optimal level of working capital, well, as I said, there are 3 approaches to doing this. And they are, and you should know them, right? This is something you should know. You should know what they're about, but also what pros and cons they've got. Although the pros and cons, the advantages and disadvantages are pretty straightforward. So the first of these approaches is going to be what's known as the conservative approach to working capital management. And this one is all about keeping more cash in the business than may necessarily be needed. Also having more receivables and higher levels of inventory. That's, that final one. Higher levels of inventory means you're stocking up. I'm tempted to say excessively, in the sense you have more inventory than you need, but a lot of it is sort of just in case, a buffer. What if we have supply disruptions, for example? Well, or you've got some shocks in demand, excessively high demand, unanticipated. Well, then you've got inventory to deal with that. And on the one hand, you've got higher assets in the form of more cash, more receivables, more inventory. And obviously that requires financing or funding on the other side of the balance sheet. And whereas normally with sort of working capital management, you would typically finance this using short-term debt, including trade payables. Well, here this is combined with a higher reliance on long-term debt so not short-term, but also equity funding. And, this is the stable type of funding which you will not have to all of a sudden repay just because somebody doesn't roll over or prolong your short-term borrowing. I mean, equity is a permanent source of funding. So this really is conservative, because typically you would fund your working capital investments into inventory, into receivables with short-term funding. Here we kind of go against that and prefer to be quite conservative in our approach. And let's think about the pluses, the upsides and the downsides of this approach. So this is the downside, that's the upside. Well, the benefits. If you borrow using long-term debt and equity, then as we said, this type of funding is stable, it's predictable, it's more or less permanent. Of course, long-term debt isn't permanent, but at least permanent in the shorter term. And this gives you a lot of flexibility in the sense that you will not be asked to repay this money back anytime soon, I guess. And very importantly, there is, with debt at least, and for that matter with equity, there really is no imminent rollover risk in the sense of having to refinance this. Which is the case with short-term debt, right? Rollover risk is always present when you borrow money short-term and need to ask for money again just to keep the loan going. In the case of long-term debt, at least, the financing cost is typically sort of known upfront, especially if you're paying fixed interest on the borrowing. And you will not have to renegotiate that all the time. And you've got, let's say, not just flexibility, but also certainty of working capital. As I said, if you stock up more than may necessarily be the imminent need in inventories, at least you've got a buffer, which gives you some certainty. Now, the problem with this approach, or the problems are numerous. Yes, it is comfortable to have that flexibility and that certainty, but it comes at a cost, because funding the investment into short-term assets with long-term debt and equity means you're funding it with relatively expensive sources of funding. So long-term debt is typically more expensive than short-term debt. Equity and long-term debt is typically more expensive. Equity for sure is more expensive than short-term debt. And of course, the only time that this wouldn't be true is we had an inverted yield curve and short-term interest rates were a lot higher than long-term interest rates, but it doesn't necessarily happen all the time. We recently had a period of that happening, but the normal shape of the yield curve of interest rates over time is upward sloping. Another problem here is we actually borrow more than needed, because we're trying to keep a buffer, to have that flexibility, more receivables, more inventory. So you actually hold more than you need. So you borrow additional money just to have that buffer, just to have that flexibility, and you're obviously paying the bill for it in terms of higher interest. Now, also, longer-term funding or longer-term borrowing is more complex to arrange. It takes longer to arrange, so it's not necessarily something you can just do very quickly. And short-term borrowing is definitely quicker, but also if you borrow long-term, it may definitely involve more covenants, more restrictions on the company's actions, its on the way it behaves, etc. If you borrow short term, that typically doesn't come with so many constraints. longer term borrowing definitely does. Now, when will a conservative approach be typically suitable? Your curriculum lists a number of instances, and I decided to just pick a few. So this conservative approach to working capital management may be suitable if, for example, we've got an early growth company, so a company at a relatively early stage in its sort of development cycle, so early growth phase companies, which really don't have much access to short-term debt, lacking access to short-term debt, which doesn't necessarily mean that they'll have access to longer-term debt, but they will definitely have access to equity funding from the founders, and it will be via equity funding that investments in working capital in short-term assets like inventories and receivables will have to be made, not by desire, but simply by lack of alternatives. Also, this approach may be suitable for more mature companies who appreciate the comfort of operating in this way, not having to worry about, whether their existing funding will be rolled over and refinanced. And they know it comes with an extra cost, but these mature companies, ideally, who can pass the extra cost of that funding on to their loyal customers. Okay, obviously, if they've built up that kind of loyalty and customer and the ability for the customer to pay extra because they're so hooked on the product. And it also absolutely makes sense if we think that interest rates, I/R is my typical abbreviation for interest rates, if interest rates are expected to be going up, because if that's the case, why not, fund your working capital using longer-term debt funding, take advantage of the fact that interest rates are right now lower, so you lock in some financing cost instead of having to roll over short-term debt, probably at a rising cost. Now, the very opposite of the conservative approach, and this is going to be our approach number 2, is going to be what the book calls the aggressive approach to working capital management, and this is going to be sort of the absolute opposite of conservatism. So here we will minimize to the bare necessity excess cash. I mean, we will only keep enough cash to keep us going. We will keep less inventory relative to sales, of course. How much inventory you ultimately keep and have in your balance sheet is size dependent. So compared to the size or relative to the size, we're going to operate with minimum levels of inventory. So a kind of, just-in-time system. I guess receivables will be cut as well. And there will definitely be, on the other side of the balance sheet, accompanying this, more reliance on short-term funding. Okay, of course, if you rely on short-term funding, especially funding from suppliers, that may reduce your financing costs quite a lot. But and financing costs being lower means returns to shareholders are going to be higher. So you do potentially increase company value, but you do run the risk of operating with very little buffers and very little flexibility there on the asset side. So that could be problematic, especially if your short-term funding is not being extended as you hoped for. So let's have a look at some of the pros and cons of this approach, pluses and minuses. we have definitely lower financing costs over here because we're not using as much equity or as much long-term debt. We are only borrowing what is really needed to keep the company going. We're not borrowing excessively. So we don't have excess cash lying around because we've borrowed too much just in case we need to, fund some liquidity gap. And another big advantage, which you already sort of know from the previous points, that short-term borrowing typically means less meddling with the company by external debt providers, so less covenants being sort of put in place, and everything has both a positive side and a negative side. Whilst on the one hand, we don't have much flexibility in terms of not keeping excess cash. So if we get into a bit of a sort of problem, that might prove to be quite disastrous. But on the other hand, because we're using short-term debt, we've got the flexibility to refinance our borrowing if interest rates in the market go down, so lock in a lower rate. Whereas if you've got long-term debt, you kind of have to keep paying that steady fixed interest rate, which on the one hand is good because it's predictable, but it may mean that you're missing out on the opportunity to borrow at a cheaper rate. And there are plenty of downsides to this approach. The cost of borrowing here is volatile because, we're constantly forced to refinance at new rates. And whilst on the one hand, that gives us the flexibility to refinance if interest rates drop, who says interest rates have to drop? They may just as well go up. We face the risk of rolling over, so rollover risk. If you're borrowing short-term funding from a bank or generally from the markets, for example, by issuing what we call CDs, commercial paper, not CDs, commercial paper, and then, people may stop wanting to buy your commercial paper, in which case you can't roll your debt over effectively. Okay, what else? You may face these cash spikes, additional need for cash to repay your debt, especially if people don't want to roll over your existing debt and refinance your needs. And you're going to rely quite heavily here on trade credit. Now, a lot of the time we assume trade credit, so that's credit from suppliers not demanding immediate payment for what they supply to the company. We consider that to be typically to be cost-free because they don't charge any explicit interest. But as we discussed in a previous video where we computed the effective annual rate of supplier financing, sometimes there is an implicit cost involved because, yes, you don't pay any interest to the supplier on the balances you owe to them, but if you use the full term which the supplier is giving you, you may be missing out or you may be foregoing some kind of discount for quicker payment. And if you're forced to extend the payment until the last possible date, then you are missing sometimes on a potentially attractive discount, which actually means that this extension is not cost-free because it costs you the lost discount. And that lost discount, when you annualize it, may be quite an expensive thing to forego. So reliance on trade credit, which may, in fact, although it's never explicitly stated, may be quite costly to use if you're foregoing a prompt payment discount or some kind of quick payment discount. That is in itself a disadvantage, right? And your suppliers may tighten conditions as well, may stop extending credit to such an extent. Right, when does this so-called aggressive approach make sense? Well, it makes sense if the company is really able to forecast its cash needs precisely. If you've got the methodology, the models, and a predictable business which allows you to do this, yes, there probably isn't much need to keep buffers and flexibility, which is the case under the conservative approach. A conservative approach to cash management may be well suited for a business that's very volatile in terms of the demand for its products, etc. So probably you're making, because the business is quite volatile, so you're taking a lot more risk in the business. You need to act more conservatively with your cash management, not to run out of liquidity. Whereas if your business is quite predictable, then you can afford to be more aggressive with your cash management. At least that's the way we can think about it. And it also makes sense, everything aside, if we expect interest rates to if interest rates are expected to go down, because this is where you don't necessarily want to be locked up in long-term borrowing agreements. You probably want short-term debt agreements, which allow you to roll over systematically and take advantage of the lower rates. Now, the third approach here, so we've had the conservative approach, then we had an aggressive approach, and now we're going to have something which is in between, and that's what the book calls the moderate approach to working capital management, moderate approach. The third one, which is of course some kind of balance between aggressive and conservative. The company is going to typically employ different sorts of funding to fund different types of assets. So it's going to use longer term financing, like long-term debt, primarily and predominantly to fund permanent current assets. Right, okay, so what do we mean by this? Typically, let's take something like inventory, right? Although inventory levels fluctuate up and down, typically on a quarterly basis, especially if you've got a company that's seasonal, right? So depending on the season, there will be more or less inventory in place. However, you will typically have some, let's say, core level of inventories in the business, a core balance that is more or less sustained throughout the whole year. So this is what we call a sort of permanent core level of current assets. And I just showed you the example of inventories, but the same goes with receivables, for receivables which are a function of your sales, right? And if sales fluctuate in volume, sometimes there will be more receivables and at other times there will be less. But you'll typically have some persistent core permanent level, and you'll typically want to fund this using longer term financing. However, the fluctuations, which are a result of seasonality here, for example, will typically be funded using shorter term debt, so as not to borrow too much, seeing as those fluctuations sometimes completely disappear, or those excesses completely disappear. So once again, why borrow more than you need? And this is going to fund your variable current assets. So, for example, those spikes in inventory, and that variability may be seasonal, or it may result from sort of planned growth. So it doesn't have to be seasonal. You may be planning to grow this, but in the meantime, you're not piling on additional long-term debt to fund those growing current assets. The element of growth is being funded using short-term debt, which is subsequently being replaced by longer term funding. So growth-based needs as well. Okay, so hopefully we have clarity here regarding on when this approach is used. This actually this application of the moderate approach is also known as the matched approach. So an approach where you fund, please note that we're not talking about long-lived assets here, we're talking about the way to fund current assets, but within current assets we distinguish between elements which are, or components which are quite permanent versus variable. And it's not that certain lines within current assets are this or this, it's that every line, like inventory, receivables, for example, will have both a core permanent component as well as a more variable component to it. Right, so what are going to be the advantages and disadvantages of this so-called moderate approach? Well, to be honest, the advantages and disadvantages, come from the fact that this is neither of the two extreme conservative and aggressive approaches. So, as an advantage, your book says, this has a lower cost of funding than under the conservative approach. Yes, because under the conservative approach, your aim is to predominantly fund your current assets with longer-term funding needs, which are always more expensive. But you could flip this around and say, but it's also more expensive than the aggressive approach. Right. Now, it also gives you more flexibility to increase the financing needed for seasonal and growth requirements. Once again, this is versus the conservative approach where you pretty much borrow fixed amounts for longer terms and you borrow excessively. And I guess something that may not be so obvious is that you have a more diversified or more diversified sources of funding, as opposed to either aggressive or conservative, where it's all about long-term funding or pretty much all about short-term funding. So more diversified sources of funding your current assets. On the flip side, on the negative side, your book says, well, you are using short-term debt and access to it may dry up. Debt sources may become limited. Obviously, you could say the same thing about the aggressive approach, become limited. Short-term funding always comes with cost uncertainty. We said that before. You have to roll it over using whatever is the current level of interest rates, or accepting the current level of interest rates. So cost uncertainty for short-term funding, and of course may need to rely on trade credit, which your book doesn't absolutely treat as something that's cost-free. It says that it could be expensive if you need to forego certain trade discounts, as I mentioned before and as we discussed in a previous video. So please appreciate the nature of these three approaches, their pros and cons. I think the last one is the easiest because you can easily answer pro and con questions because they kind of strike you as quite evident. Now I just want to say a few finishing words about liquidity, as your book does as well. So liquidity at the level of a company is defined as that company's ability to meet short-term obligations, short-term payment obligations, to settle those obligations. And your book decides to talk about what it considers elements as a prudent short-term strategy. So a prudent short-term approach to liquidity management. So prudent short-term approach to liquidity management. And it says, now these are quite arbitrary, so I'm just going to quickly list them, but I think there are so many different points one should also consider. This you can say this is liquidity stroke working capital management, because liquidity is very much connected with working capital management. First of all, maintain. So these are sort of the golden rules, right? Maintain sufficient, but also diversified sources. Don't borrow from just one place, right? Of credit. So have some from your suppliers, some from a bank, maybe not a single bank, I don't know, in order to fund your ongoing cash needs. Right. Now, the second sort of commandment here is secure funding, but this time funding capacity. So have a buffer, have somewhere like a cushion, right, which you can tap into, an extra source you can tap into to handle changing cash needs. For example, if you've got seasonality in the business or growth in the business that's been planned, make sure you have liquidity, let's say, on hand for this, or capacity arranged for this. Because one of the biggest problems in business, to be honest, that I as an analyst see, especially when you work with medium-sized or smaller businesses, is they don't necessarily plan for liquidity when the company is doing well. When a company is doing well, its working capital needs increase because more needs to be invested into inventory, more needs to be invested into receivables. And a company that's doing well and wants to expand actually has sometimes problems with liquidity because they didn't plan for that extra investment to be made. It's much easier to plan for investments to be made into property, plant and equipment, things like machinery, production facilities, but not a lot of people think about the cash that's frozen up into current assets. Now, another point, but I would say this is just normal practice, okay, it's prudent, is confirm the rates and terms offered by your suppliers of funding, and confirm those rates and terms offered are indeed competitive. And this should include the implicit and explicit costs of funding. And those implicit costs are especially important when you're funded by your suppliers, but you may think, as I've said, I think 2 times or 3 times already, you may think it's cost-free. They don't charge you an interest rate. They allow you to pay 60 days or 30, 60, 90 days following the receipt of goods or materials, and you still don't need to pay. Brilliant, that's free funding. Well, it's not free if you're giving up a discount which you would receive on the purchase price if you had paid within a shorter period of time, and you need to be able to factor that into the computation of the cost. Now, the book also talks about some additional factors that need to be considered, or which I guess influence a company's approach to the matter of working capital. So kind of how it chooses to function in terms of the conservative, aggressive or moderate approach. Size is a big factor. Large firms have better access to short-term funding, especially of an unsecured nature. Access to short-term funding, they can easily borrow from banks, but they can easily also issue something like commercial paper, quick short-term funding, which smaller companies don't have access to. They will also be affected by credit worthiness, right? Because that has an impact on the severity of covenants, and of course the rates at which the borrowing happens. So if you're not very creditworthy as a company, as would be typically the case with early stage sort of growth companies, early growth stage companies, you may be confined to funding everything, including short-term assets, using equity predominantly, or long-term debt of a very secured nature. Now, legal considerations will also be potentially important, but this is more associated with the fact that it's not company specific, it's more country specific or market specific, especially in developing markets. So in less developed parts of the world, we may have a less well-defined legal system, or legal systems, less well-defined legal systems. And that means the options available for funding, to get funding, are just going to be limited and fewer. So there will be fewer funding options as such. Sometimes our choice of funding approach is driven by regulation, so regulatory considerations or limitations, and this is applicable to certain industries, e.g. Banks are quite regulated both on how they invest but also how they are funded, and your book always in this case mentions utilities, that they are restricted in terms of what type of borrowing they kind of take on. And let's not forget that to a large extent your choices in terms of how you fund the company are going to be driven by the availability of specific assets, what types of assets, underlying assets the company has, because we or lenders, let's say, like to provide funding if they can, especially get some kind of security in place, so collateral. And what's suitable as collateral for short-term funding is quite different to the typical collateral for long-term funding. If you're borrowing long-term, then you typically have long-term assets like buildings, property, plant and equipment being used as the collateral, whereas for short-term funding, typical collateral will be stuff like inventories. And the question is, what inventories do you have? What type they are? What is the risk associated with them, especially the risk of them going obsolete or going bad? And it's quite possible it's quite common in the finance industry, in the financial markets, to get funding where inventory is used as collateral. It just has to be the right type.